How to get financing for your business. The desire to start a new business is common among many people. Nearly 99.9% of all U.S. businesses are small businesses. They employ 60.6 million people, which translates into 47% of the total U.S. workforce. The quality of the core team, i.e., their attitude, aptitude, knowledge, competence, and skills, directly influence the speed at which a startup achieves its growth milestones. A good team brings synergy to the combined effort of the people and maintains motivation for better results across all levels of the business. However, money-related issues were the most common reasons the startups failed, with a combined 40% citing running out of cash or a lack of funding as a reason for failure. Acclivis, Entrepreneurial Coaching, Ascending Beyond Expectation. Allow us to answer some questions for you. Determine how much funding you'll need. Every business has different needs, and no financial solution is one size fits all. Your personal, financial situation and vision for your business will shape the financial future of your business. Self-funding with 401k. Otherwise known as bootstrapping, self-funding lets you leverage your own financial resources to support your business. Self-funding can come in the form of turning to family and friends for capital, using your savings accounts, or even tapping into your 401k. You retain complete control over the business with self-funding, but you also take on all the risk yourself. Be careful not to spend more than you can afford, and be especially careful if you choose to tap into retirement accounts early. You might face expensive fees or penalties or damage your ability to retire on time, so you should check with your plan's administrator and a personal financial advisor first. Get venture capital from investors. Investors can give you funding to start your business in the form of venture capital investments. Venture capital is usually offered in exchange for an ownership share and active role in the company. Venture capital differs from traditional financing in several fundamental ways. Venture capital typically focuses high-growth companies, invests capital in return for equity, rather than debt. It's not a loan. Takes higher risks in exchange for potentially higher returns. Has a longer investment horizon than traditional financing. Almost all venture capitalists will, at a minimum, want a seat on the board of directors. So be prepared to give up some portion of both control and ownership of your company in exchange for funding. Crowdfunding to fund your business. Crowdfunding raises funds for a business from a large number of people, called crowdfunders. Crowdfunders aren't technically investors because they don't receive a share of ownership in the business and don't expect a financial return on their money. Instead, crowdfunders expect to get a gift from your company as thanks for their contribution. Often, that gift is the product you plan to sell or other special perks, like meeting the business owner or getting their name in the credits. This makes crowdfunding a popular option for people who want to produce creative works, like a documentary, or a physical product, like a high-tech cooler. Crowdfunding is also popular because it's very low risk for business owners. Not only do you get to retain complete control of your company, but if your plan fails, you're typically under no obligation to repay your crowdfunders. Every crowdfunding platform is different, so make sure to read the fine print and understand your entire financial and legal obligations. Government-backed small business loan. Consider a small business loan if you want to retain complete control of your business but don't have enough funds to start. Once you have your materials ready, contact banks and credit unions to request a loan. You'll want to compare offers to get the best possible terms for your loan. Credit cards. Credit cards can offer convenience for businesses that need a way to charge expenses and pay them off later. Not to mention, there are plenty of credit cards for financing businesses that can pay you something back in the form of points, miles, or cashback. If you're considering a credit card for financing a startup business, make sure you understand the difference between personal and business cards. While you could use a personal credit card for business expenses, that can get messy when accounting and filing business taxes. A business credit card could be reserved just for business expenses. Whether you're eyeing a personal or business credit card, read the fine print. Specifically, pay attention to regular and introductory APRs for purchases and balance transfers. Annual fees. Rewards program. Card benefits, such as premium travel benefits or shopping protections. Remember, when applying for a business credit card or a personal one, your credit score matters. The better your credit score, the better your odds of getting approved and getting a low interest rate. One word of caution about using credit cards for financing a new business. Taking a cash advance from a credit card is tempting when you need money fast, but the fees and APR you might pay can make it an expensive financing option. So your best bet may be using your card for business purchases only and looking elsewhere when you need cash. Angel investors. Angel investors and venture capital are two options for how to finance a business that doesn't involve borrowing money. Instead, you're essentially getting funding from individuals or companies that invest in startups. Working with angel investors to finance a business has some key advantages, chiefly that the money you're getting doesn't have to be paid back. That means if for some reason, your business doesn't take off, you aren't left with a mountain of business loan debt to repay. Compared to getting a business loan, which might tap out at $100,000 or $500,000, you may be able to raise millions in funding through angel investors. There is a trade-off you make, however. When you accept financing from angel investors or venture capital firms, it's typically on the condition that you offer your investors an equity stake in your business. In other words, you're giving up some of your ownership and control in the company in exchange for an equity investment. That's something you need to be sure you're comfortable with before exploring angel investments or venture capital financing. Business loans and lines of credit. Business loans and lines of credit are two of the more traditional options for how to finance a new business. The great thing about loans is that there are so many different options. Microloans have been mentioned already, but you could also look into short-term loans, long-term loans, development loans, equipment financing. Remember that some business loans may be more challenging to qualify for than others, especially if you have a brand new business. And you may have a more difficult time getting a term loan from a bank, whereas an online lender may be more flexible in offering to finance new businesses. A business line of credit could be easier to get approved for, but it works a little differently than a loan. With a loan, you're getting a lump sum of money that you can use to fund your business. You then repay the loan according to the repayment schedule set by the lender. On the other hand, a line of credit can be a revolving credit limit similar to a credit card. You draw on your credit line as needed to make purchases for the business, then repay those amounts. As you make monthly payments against your balance, you free up available credit that you can use again for future expenses. This could offer more flexibility when financing a startup, plus you only pay interest on the portion of your credit line you're using. Factoring. Factoring is something you might consider when financing a startup if you already have some customers and cash flow coming in. With factoring, you're leveraging your outstanding accounts receivable to borrow money for your business. A factoring company lends you money based on the value of your receivables. Depending on how the financing company works, you may repay what you borrow as invoices are paid, or the lender may collect payment directly from your customers. This kind of small business financing option is to consider if your operating history and credit history don't allow you to qualify for other types of financing. It's similar to a merchant cash advance or inventory financing in the sense that you don't need perfect financials to qualify, and you don't have to offer collateral the way you might with a traditional loan. The downside is that factoring can get expensive since lenders may charge fees rather than a standard annual percentage rate. Depending on the amount you borrow and your repayment terms, the equivalent APR associated with factoring or any other type of cash advance financing could end up being well into the double-digit range. Disclaimer. We are not financial advisors and are not providing opinions for your financial decision-making processes. Therefore, we should not be held accountable for any information delivered in this message.
Provided with the courtesy of Aclivis. For more information go to www.aclivis.company.
Thanks for watching the complete video. Subscribe to our channel to get more knowledgeable videos like this.